Welcome to the Grow Your Law Firm podcast, brought to you by Pilma. This podcast helps lead lawyers to more growth, profit, and freedom. Here is your legal marketing expert and host, Ken Hardison.
Well, hello, everyone. This is Ken Hardison. Welcome to another episode of Grow Your Law Firm. And today we have Boris Musheyev. I know I killed it again, but anyway, a CPA with Boris M Tax Inc. out of New York. And Boris is a CPA that helps attorneys save money on taxes. And I can verify that the first year I hired him, he saved me close to 40 grand on my income taxes. And I appreciate that, Boris. And it was about half the price of my former CPA and saved me, so he paid for himself many times over. But that's not what we're here for today, is for me to brag on you. Today is really, we wanted to talk about year-end tax planning, and then we'll probably touch on what's going to happen next year with a new president and maybe a new Senate, but we'll see. But we'll talk about that at the end. So, Boris, anything you want to add to your resume? And he's author of several books too on tax savings for attorneys. So I forgot to mention that. Sorry.
No worries. Thanks so much for the introduction, Ken. So just a little bit about myself, so that before we get started and get some credibility with people that are listening. So my name is Boris Musheyev. I'm a CPA, but I'm also a certified tax planner. And, I graduated college in Baruch College here in New York, and I was sucked into the world of traditional accounting, grinding through tax season, preparing almost 500 tax returns during tax season. That's like in 3.5 months, right? So I was completely burned out. My clients were really overpaying in taxes. And I was like, okay, well, yeah, obviously there's just no value in doing taxes. So I needed to do something about it. So that's when I ventured out on my own and really started the tax planning firm. And I picked attorneys to be my niche. And to be honest with you, I was going to quit after 3 months working with attorneys. I mean, there's one of the hardest people to work with, probably. And then I get questioned a lot when I go to any seminars, it's professional networks, and I tell them I work with attorneys. Like, wow, that must be a tough niche. I'm like, you know what, it is. And I was going to quit 3 months after, but then I realized if I cannot master this niche, I cannot master, basically, if I can master this niche, I can master any niche. So, and it's been a great ride for the past 2 years working with attorneys and law firms throughout the country. We currently have clients in about 20 states right now, and really specialize and focused on bringing in clients just for tax planning, providing strategies to save the money on taxes. Because I always say that tax planning is not only for the big boys, right? If you have a profitable business, there's money to be saved on taxes, and that is using legal tax strategies and doing proactive tax planning.
Well, so very impressive, my friend. And I see you got your book right beside you, Thinking Outside the Tax Box.
Yes.
Is that your book?
Yeah, that is a book. This was just recently published, which is Thinking Outside the Tax Box. I am a co-author of this book with other tax planning professionals. We also have a book for attorneys as well. And we can talk about that, I guess, towards the end. Specifically for attorneys and the strategies that attorneys can use to save money on taxes.
Okay. Well, Boris, let's just start with it. What are the top things lawyers should do to save on their tax bills between now and December?
Yeah, so that's a great question. So there's still some time left in the by the end of the year to take advantage of something. So I did actually outline 5 things that attorneys should do. But I wanted to also bring to your attention and to the listeners, of course, that right now we're in the month of November, right? The election has just almost been decided, and looks like Biden is going to be president, and we don't know what's going to happen in the Senate. If the Democrats do take over the Senate after the elections in Georgia in January, then it's a very high chance that the Biden's tax policies will come into fruition, right? And we're going to talk about tax strategies on this show, but I also wanted to, every time I'll mention a strategy or things that they can do, we'll also bring into the comparison, what could that look like under the Biden administration and his tax law. So one of the things I always do for my attorney clients, any attorney prospect, anybody that I speak to, Ken, we did that for you as well. And we're actually, you and I just talking about it before we got on the show, is that always reassess your compensation, right? Attorneys, especially profitable attorneys, especially personal injury attorneys in your field, they make a decent amount of money. And when that money comes into a corporation or to their business, they take that money out as a salary. And a lot of attorneys tend to take out a really high salary, or personal injury attorneys. If they're netting $2 to $3 million in a business, or even $1 million, they tend to take out a few hundreds of thousands of dollars on their salary. So what you want to do is reassess your compensation, because the IRS clearly says that your compensation should be reasonable, right? Reasonable meaning to say, don't take out a $10,000 salary trying to avoid FICA taxes, but don't take out too much of it, meaning to say so that you are overpaying your FICA taxes, right? It should be reasonable. So you need to reassess your compensation and really create an owner compensation package, just like you and I were talking about, Ken, before this, is that as an owner of a company, if you have a corporation, right, most of the attorneys are set up as an S corp or looking to set up as an S corp, you can include certain benefits in your salary. Now, as an owner of an S corporation who owns more than 2%, you cannot take any fringe benefits from the business. That's just the IRS law. But there are some ways that you can, and the IRS allows it. For example, if you include health insurance as part of your compensation, right, you won't be paying any FICA tax on those premiums. You cannot open up an HSA account for the business, but you can open up for personally. And if you qualify, that's another $7,100 deduction, which is going to save you a few $1,000s on taxes. The compensation, meaning say your salary, reassessing your salary, coupled together with some package, compensation package, health insurance and deductions and other things that you can do, could really save you, quite a bit of money. Now, usually by the end of the year, reassessing your compensation might not save you a lot of money on taxes, because we are going towards the end of the year, but it will prepare you. For example, a personal injury attorney that we work with, his compensation was over $400,000. After doing the compensation analysis for him, his salary, I can't recall, I think it was supposed to be under $200,000. I can't recall the exact figure. Now, we're already late by the end of the year, because we recently started working together to adjust the whole thing, but we stopped the salary, right? So he's not going to reach that 400,000. And next year, we're going to make sure that it's going to be not to exceed whatever that analysis that we did, which is, I believe it was under $200,000. Can't recall the exact number. So that's the first thing I would say. Always reassess your compensation. Talk to your accountant or whoever you work with. And then the second thing is make sure to take a home office deduction. Now, there is a big misconception is that, and the myth that you will get audited if you have to take a home office deduction, and that it's it's not something that I want to do. Well, that myth was true, I would say, in 1980s. But then, in our day and age, everybody works from home. And it's not one of those red flags anymore. It's actually normal, especially with pandemic. Show me, people that didn't work from home, right? You are allowed to take this deduction. Now, if you have another office location, are you still allowed to take a home office deduction? The answer is no. But if your home office was used for administrative purposes, then it can qualify. Again, it gets a little bit more detailed than that. But if you do that and you take that deduction, it'll be worth your while. Again, another personal injury attorney of ours who we delivered the tax plan to included home office deduction because he purchased his home for over $2 million. That's a big interest deduction there, right? If you really take the home office, the percentage of the square footage and all that stuff really, mounted up to quite a bit of money. The third thing I would talk about is maximizing your retirement. This is one of the biggest mistakes I see with all attorneys across the country. Some attorneys don't have retirement, some do. And those that do are making a mistake. And those that don't, not making a mistake, number one, they don't really know which direction to go to. Their accountant doesn't advise them on the proper retirement, but if they do, in most cases, 99% of cases, not the proper retirement. But those that do have a retirement, they're not maximizing it. So I will give you all a very simple example, right? Everybody's familiar with what is 401k, correct? So a 401k is something that you put money away into your retirement. Well, guess what? A 401k allows employees to put money into retirement as well. Every employee in America can put away up to $19,500 of their own pay. Every employee in America, right? Now, that is an advantage to you as a business owner, because you as a business owner, you obviously have the cash flow to put away 19,500, at least in most cases, right? Employees might not. You've got employees making 50 or 60 or $70,000. They don't want to put away that much money. So a lot of attorneys that I work with have a 401k and they only putting away 3 or 4 or 5%, basically only the match. But hey, you don't have to put away only 3 or 4 or 5%. You're deferring your own salary. It's a portion of your own salary that is going into it. So if you're over the age of 50, then that's additional $6,500. So it's $26,000 from your own salary. And your company will still do 3%. It doesn't mean you have to do $26,000 for your other employees. You're still under 3%. Like I said, any employee in America can defer their own salary. So because you have a business, because you're drawing a salary, that is why you can defer your own 401k. So if you're currently not maximizing your 401k, then you should. And if you currently do not have any retirement, you should really speak to your financial advisor and a CPA together. Always make sure that your financial advisor and your CPA are always talking to each other, because the financial advisor doesn't really know about the tax consequence. They know generally the tax deduction that it'll give you, right? But the CPA on the other hand doesn't really know all the financial intricacies of the retirement accounts. I've taken upon myself to learn them. I'm not licensed as a financial advisor, but I've learned them, because this way we can advise our clients what's in. I think we did the exact same thing with you, Ken, right? You're constantly talking with your financial advisor to make sure that it's implemented the right way. And there's other things such as profit sharing account. 1 year 401k was not good for you, Ken, and with the profit sharing, which really helped you a lot, right? So again, work with a CPA that knows these options, and the financial advisor can implement these options, right? Super, super important. That was the third thing. The fourth thing, by the way, Ken, any questions so far, if I'm going too fast?
No, I did have one question. You said something about a HSA account, or HS account.
Mm-hmm.
Can you explain a little bit more what that is? Because you kind of brushed over that. And I want to make sure I know what it is, but I want our listeners to know what it is.
Yes, the HSA account is a health savings account, right? So basically it means that you can put money into a health savings account and pay for your expenses from that account, for your medical expenses, but not your health insurance premiums. Now, you do have to qualify for health insurance to have a health savings account. You have to have a high deductible plan and a certain out of pocket. I don't have those numbers in front of me, but most health insurance providers will let you know if your plan qualifies. Basically, what I love about HSA is, actually, thanks for bringing it up, Ken, is because let me take a step back for a second. What happens when you put money into your retirement account? You get a tax deduction, right? The money has investment income and it grows, and when you retire, that retirement is actually subject to income taxes, right? Tax deduction now, no tax deduction later. The fourth thing that I was going to talk to you guys about actually is a Roth IRA. The Roth IRA, no tax deduction now, no taxable income later, right? So we've got a regular retirement, tax deduction, taxable income. Roth, no tax deduction, no taxable income. With HSA, it's very different. Tax deduction now, no taxable income later. So let's say you're healthy, and God bless you, right? You're healthy for many years and you keep putting money away into your HSA account. Currently, the limit is $7,100 for family. Let's say you're doing that for 10 years, $70,000. With earnings, it's now let's just say $100,000 after 10 years. Well, guess what? And if you have medical expenses as you're getting older or in your retirement age, you take the money out for those medical expenses, none of that money is actually taxable to you. But it was a tax deduction when you put it away right now. So great vehicle for you to take advantage of. So was that clear, Ken?
Yeah. What happens if, I guess if you take it out for things other than health, I guess you got to pay the taxes, right?
You got to pick it up as an income. Yep. Do you have to pick it up as an income if you do that? So better to use it for medical expenses. And the best thing about it, like I said, it rolls over.
Yeah. And
the fourth thing,
when you say medical, that could be dental,
mm-hmm.
eyes. It don't have to just be a doctor, right?
Yep.
hearing aids, things like that.
Medical expenses, just not health insurance premiums.
Right.
And
Okay.
again, we can provide a list of all those medical expenses to your listeners, but anybody that wants to open it should definitely consider and see if you qualify.
Yeah.
And the fourth thing I wanted to talk to you about, you said, what are the 5 things that attorneys should do to save money on taxes? This is not more of a saving money now, but more later. The Roth IRA. This is really something very important that I speak to about everyone, and I think we're doing that for you as well. Again, is Roth IRA. So Roth IRA is a retirement vehicle that you put the money in. It's after tax dollars, meaning to say you don't get a deduction for it. There is a limit up to $6,000, and if you're age of 50 or more, $7,000 per person to put the money into your Roth. The money stays there and has investment income. When you're ready to retire, all of that income will be tax-free to you. That's one of the ways to have, not to put all your eggs in one basket. Yes, you will have Social Security income when you retire. Yes, you will have retirement income when you retire. You might have some rental properties and some investments, but at the same time, you will have Roth IRA, which is a tax-free income. Now, a lot of you listeners who are personal injury attorneys, they probably won't qualify for Roth IRA because they're over the income threshold. Okay, so there's something that is a beautiful thing in the IRS tax code that is called backdoor conversion, right? Or backdoor Roth, meaning to say you'll put the money into traditional IRA. You're not going to get any deduction because you're making too much money. There's no limit to put money into traditional. Then you call your financial advisor and say, I want to do backdoor Roth. He says, yes, sir. And then he takes that money and converts it to Roth. Just make sure your financial advisor knows the term backdoor Roth. If he does not know the backdoor Roth, probably is not a good idea to continue working with them, right? Because really, all the financial advisors should know this, right? And really, and if you're married, that's $14,000 of contribution every year over 10, 15, 20 years. That could mount up to a good retirement income, right? Tax-free income. Now, I want to take a step back for a second, everybody. I did promise you that I will talk to you about how these strategies that we're discussing today is going to be affected if we have new tax law under the Biden administration. So I'm going to go back to your salary right now for a second, right? If you're drawing a salary from the business, you are paying Social Security Medicare tax. Everybody knows that, right? This Social Security tax stops at $147,000 for 2021, I believe, right? $147,200, I think. But then you continue paying Medicare tax. The Social Security tax is 6.2%. As an owner-employer, you're paying 12.4%, double, right? So that's what happens. Now, after 147, it stops. Now, if Biden becomes president officially, right now he's already a president-elect, right? What happens, he vows that everybody making over $400,000, that's who he's increasing taxes for. And I looked at it. I looked at the policies. They don't look pretty for anybody making over $400,000. I'll be honest with you, it does not look pretty. One of the examples is that Social Security tax is going to stop at $147,000. Well, it's going to come back if you're going to start making over $400,000 and your salary is over $400,000. So basically, there's a gap. There is no extra Social Security tax between 147 and 400. When you're making over 400, there will be. As of right now, the way we saw the information, that could change possibly, right? As of the date we're doing this podcast, November 11th, 2020, that's what they're saying. So that is why very important to reassess your salary and make sure it's under all those thresholds, legally, of course, right? You want to make sure you do analysis and all of that stuff. Speak to your CPA, or you can contact us to do that for you. And
yeah, because you have some software that actually helps you do that, if I remember.
Yep. We have that software that we pretty much go by your tasks. Like we ask you, what do you do in your business? Clerical work, paralegal work, whatever it is, 10% of this, 15% of that, 5% of this, 3% of bookkeeping, and that really reduces down how much time you're spending as an attorney, because attorneys, highest paid of all those categories. So that is how we're able to legally provide you with that breakdown of, basically reducing your salary. Yep. So the fifth thing that we can do this year, which could help you on your taxes, but could definitely help you next year. And, I start talking a lot about this to my clients, prospective clients, current clients that we have, is really investment in real estate, right? If you've got money, right? If you have money, you've cash sitting around, put that cash to good use, invest it in real estate. The reason is because as of right now, we have a lot of great benefits for investing in real estate. Now, all of you or some of you are familiar maybe with 1031 exchange, right? 1031, I'm selling a real estate investment property. I have a gain, but I am rolling that gain over into the new property within a certain period of time, and I don't pay any tax on that gain, right? Well, with Biden's tax policies, they want to eliminate that 1031, right? But it's not to say still don't invest in real estate, because there are other opportunities with real estate. There is better cash flow with real estate. And what do I mean by that? We actually showed this example in one of the tax plans for one of the personal injury attorneys. Actually, think about it this way: if you got $100,000 sitting in making you 10% in a stock market, right, and you put $100,000 down payment on a, let's say, $500,000 rental property, and it's only making 7% return, well, you're really making less than what the stock market is making you, right? Well, that is true, but against that 7%, you can take a depreciation deduction on your property and really wipe off that 7% return on investment, right? And then the depreciation deduction can actually produce a loss to you. And that loss could actually be deducted from your other income, from your business, for example, and really give you a very good tax break. At the end of the day, you're walking away with a good tax benefit and cash flow in your pocket. Now, this is just a very general example. For some people it works, for some people it doesn't, but those losses do get carried over. But that is a super important tax planning analysis that you can do. Hey, should I be investing in real estate? Do I have money? How will it help me on taxes, right? I'm not a real estate advisor or an investment advisor. I really strictly look at it from the tax perspective.
Boris, so thinking what you're just saying, I would think that it would be a good idea for a lawyer, if he's pretty much sure he's not going to outgrow it, is to buy an office building. I mean, his own office building, and rent it through a corporate, I guess, and rent it to his law firm or whatever. And because the thing that I like about real estate is that, yeah, you might not make 7% when you get the write-offs, but the other thing I like is not only are you making the 7% then, but it's appreciating in value, even though you're depreciating it. You know what I'm saying?
Exactly. 100%.
So when you get ready to sell it, when you get ready to retire, you can sell it as part of the deal. And then depending on what capital gains are, we can't, predict the future, but right now it would be what, 15%?
20%.
20%?
Yeah.
20%. Okay.
Depending if you're like in a higher bracket, and yeah.
Yeah. So, that's.
Yeah, absolutely. And that's the thing with it. You're right, Ken, is that we're having a positive cash flow. We're getting a tax deduction and tax breaks. It's being appreciated in value, right? And when you sell it, that appreciation could be rolled over based on the way the current tax law is into the 1031.
Yeah. And the deal is, people say, well, I can't afford it. The government, with SBA loans, they're easy to get for real estate, and the banks want to loan the money, and the government, insure like 70-80% of the loan. And you get a pretty decent interest rate, but you get it spread out over like 20 years, 20, 25 years. I can't remember exactly, but I just think that's I tell people not to buy office buildings if they're still growing, because you don't want to outgrow it, right? And you got to sell it and all that. But
anybody that is just growing their practice, and even if they're making a few $100,000s in net, or even $1 million, right? But they're still in that growth, and they're still reinvesting that money, then yes, obviously, don't go crazy buying the real estate and all that stuff. What you want to focus on doing a tax plan, right? Because tax planning is going to put cash in your pocket by doing tax strategies. There's a lot of tax strategies, right? We're only covering a few, right? There's definitely a lot of things that can be done. Everybody's situation is different. It's your entity structure. How many entities should you have, right? Should you create a management company? Is it important to create a management company? Do we really need it? How is it really going to help us, right? If you're running few businesses, really all these things need to be looked at from a bigger picture. Is this all possible? Yes, but does it apply to everybody? No, but it applies to everybody differently. Really, tax planning should be a huge part of any law firm that is really, really growing, especially personal injury law practice. Because again, I don't think this is one of the things that I was going to discuss today, but especially if you're a personal injury attorney and you're settling your own cases, you can structure those. If you're structuring your own cases, well, guess what? there are institutions out there that will help you defer your structured settlements that you don't have to pay tax now. Now, is this good for everybody? No. Does it apply to, is it good? Might be good for everybody. Some people, yes. But again, bigger picture needs to be, you have to look at it from the bigger picture, so to speak.
Yeah, and I've done that before, and the key to it is, you get your attorney fees structured, but the deal is you cannot, I'll caveat, it might change. You cannot get the check from the insurance company. It's got to go directly from them to the whatever company you're buying. You're putting the structure in the structure company, because if it comes to you and then you buy it, you got to pay taxes on it. I will tell you that.
Later on, yes, because you are deferring it, right? So again,
Yeah.
That's why I'm saying it's not for everybody, but we have to see what the future will look like, what is the current look like, how much payouts will be from those structured settlements. The point that I'm trying to make is there is a lot to discuss, right? Can we also create a tax-free retirement income of close to $100,000 per year and not pay any tax on it with non-qualified plans? Yes, you gotta speak to your financial advisors or your CPAs, or really just to have it all. Just you gotta have a tax planner to be able to that works with everybody and to do these things. Absolutely.
Okay. Well, what's number 5? Or did you just cover number 5?
Yeah, we covered that was real estate and depreciation.
Okay. Yeah. Yeah. So, I always like to talk about 179 deductions.
Yeah, I know.
I do. I always talk about it.
I think we spoke about it last year as well on one of the webinars.
Yeah. I for some reason, I've got some kind of hang up about 179s. I love them. So can you explain to our listeners or viewers what a 179 is and how you apply it and what's the advantages, disadvantages, whatever?
Yeah, so what I'm going to talk about is Section 179 and also a bonus depreciation, okay? So basically Section 179 says, hey, you can take a deduction for certain assets, up to a certain limit, all in 1 year. So let's say you bought a office furniture worth $50,000. You moved into an office for $50,000 worth of office furniture, your computers, $50,000. Section 179 allows you to take the whole thing right away in the same year. Then when Trump became president, they came up with Tax Cuts and Jobs Acts, right? TICJA. And over there, they increased the bonus depreciation from 50% to 100%, pretty much means the same thing. Just like a Section 179, you can deduct the full thing. So you might say, well, what is really the difference? And that's where planning becomes important. Because if you want to do Section 179 and it's going to create a loss for you, it will only deduct it up to your income. The rest is going to be carried over. But if you do a bonus will let you create a loss and be able to take it all in 1 year. So to answer your question, Section 179 is something that allows you to deduct your assets in full in its first year. So is bonus depreciation. But bonus depreciation, if that deduction will produce a loss, the bonus depreciation will allow you to take that loss, whereas with Section 179, it'll be carried forward to future years.
So when you say bonus, what do you mean? Like paying yourself a bonus?
No, it's just the term in the tax code, bonus depreciation, meaning to say it's just a bonus. 100% is a bonus, right? It was used to be 50%. Now it's just a terminology they use, a bonus. Instead of over 5-7 years, bonus, 100%, you get it.
Okay. So, okay, I understand it now. I just want to make sure but this thing, usually they have a cap on it. Like I've seen years where it was 150, and then I've seen years where it's $500,000. I've seen years where it's $1 million or $2 million. And they just cut the cap off completely, or do they have a cap every year?
For the Section 179, there is a cap.
Yeah. Do you know what it is for this year?
I can't recall for certain, so I don't want to say it over the air, but it's definitely, yeah, I can't recall for certain, but there is a cap. They have caps every year and they do change.
Yeah. Okay. So this 179 deal, the way I understand, you tell me if I'm wrong, the key to it is you can even buy property. You don't have to pay cash for it, but you can still deduct the whole deal for the year. Like you could buy a phone system for $80,000, but yet just put $8,000 down and then finance the other $72,000 over the next 3 years. But you get to take the whole, $80,000 or whatever it is, the whole deal that year, as long as you put it in service before December 31st. You know?
Right. Exactly.
Right?
Yeah. Even if you, that's actually a good question, Ken, because I get asked a lot. Well, I bought, so let's just be clear, when we're talking about property, we're just talking about, non real estate property. Because you cannot section 179 real estate property. We're talking, let's say, for example, office furniture. And I get asked this question a lot is, I finance, like, let's say I bought office furniture for 50,000, financed 40, put down 10. Though I only get to deduct 10. No, you get to deduct the whole thing because you own it.
Yeah,
that was a good
and
question.
I think that makes it more advantageous to maybe buy it versus lease it, because at least you get 100% deduction. Used to, that's what you wanted to do years ago, but you got to take that over each payment, so you got to still having to take it over a bunch of years. So I don't.
Well, that depends, right? Again, that's where you would talk to your tax planner and be like, all right, so I have an option to lease or buy office equipment. Lease is going to cost me $1,000 per month. It's $12,000 deduction. Do I need a $50,000 deduction this year? Because let's say, especially with personal injury attorneys, they kind of know where the firm is going in terms of cases, right? Sometimes they have this, a unique year where there's a big payout and they need that deduction. Then the answer would be finance it, right? Or I have a case that's going to be paid out next year. I have a few cases that are going to be paid out. We have, for example, a personal injury attorney down in Michigan. She's working on a huge case that's going to do, a lot of payouts, a big amount payout in a couple of years, right? So there's no reason to be that aggressive right now with the income that she has. But so if that's the case, we want to be like, all right, so let's finance it, because, even if it's a $12,000 deduction, we'll get that $12,000 that year.
Right.
So that's what I would, again, it would depend on your situation. Another thing I want to make clear, I think these are one of the things that we wanted to discuss today about is, buying an SUV, right? Yeah. So when you have an SUV and vehicle, you cannot section 179 the full thing. There's only a certain limit. So let's talk about the SUV. You can take the deduction of $25,500, even it's a $40,000 vehicle. And then based on the chart, I don't have those numbers in front of me, right? The rest could be depreciated over a certain period of time, certain amount, but the first year would be $25,550. So the vehicles, the cars are one of the very rare assets that actually have a cap on the section 179.
Yeah. And that, so what if you go out and buy a Mercedes? Has it got to be a SUV, like a what do they call it? 3 tons or 2 tons or something?
If I'm not mistaken, it should be more than $6,000 a weight. I said 6,000 pounds, yeah. Right? And then that would be considered as an SUV. They usually would have that information when selling it to you. You can actually just look it up online as well and be like, all right, is this, a smart move for me? But I believe, Ken, don't quote me on this. I know we're in November 11, 2020. This was about a month ago. I was reading an article, and I don't think I could be wrong, but I don't think starting with 2021, they will be differentiating between what's over 6,000 and what's under 6,000. I can get back to you on that for certain. But just something to take away from this podcast is that the section 179 has a cap on the vehicles. Whether it's over 6,000, under 6,000, that has traditionally played a difference. For 2021, I don't think there is a difference anymore, whether it's over 6,000, under 6,000. I am not 100% sure, but I believe that would be the case. We would have to double check that. But like I said, to take away from this is that section 179 is limited to the car or autos.
Yeah, and to do it could be a used car. It doesn't have to be a new car, right?
Right. So again, we would have to refer to what that particular tax year is, would qualify. Some tax years would have it new, some would have it used. Yeah.
So, one of the big deals I used to do at the end of the year, and I probably didn't do it completely correct. So I want you to give it straight, so these lawyers that are listening to this don't mess it up. Is when I had to take taxation, believe it or not, when I was in law school, and former IRS lawyer taught it. And his big deal was defer. And I said, well, you're gonna have to pay it one day. He said, when you die, it don't matter. You won't never have to pay it because you'll die. So I always thought about that. So the deal is, at the end of the year, I used to see if I had a good year, I tried to prepay it. I'd make like my TV ads. I would try to, if I could work out maybe a great deal and get an extra 10% off by prepaying the whole deal. But I understand there's some things you can't, like I've heard that you can't prepay lease payments, or certain things like that. But can you kind of, clarify that? I mean, what can you write off, prepay, and what can you not prepay and write off?
Yes, good question. So before I tell you what you can, you cannot do, you should really consider, or anybody that's listening, right? Not particularly you can, but you should really consider what tax consequence is it going to have this year against next year. Are you going to be in a higher bracket? Because if you're going to be in a higher bracket right now, don't prepay it right now. I mean, excuse me, if you're going to be in a higher bracket next year, don't prepay it right now, right? That's important. That's important. But can you prepay your expenses, and why would you do that? We will actually cover that right now. The expenses that you can prepay based on the safe harbor rule in the IRS is that anything that has a 12-month term, a contract. For example, your lease is usually a 12-month lease, right? So you can prepay your rent on your office building, right? So anything that has that 12-month commitment to it, you can. Insurances usually you can, because they're 12-month. Okay, so again, that's based on the safe harbor. Now, why would you want to prepay? Well, that would depend. For example, if you're not, first of all, if you're not going to be in a higher bracket next year. The second thing is that one thing we didn't talk about this time, but we always talk about with your listeners, is QBI deduction, right? Qualified business income deduction, that 20% haircut for all the pass-through entities that was passed under the uh, uh, Tax Cuts and Jobs Act, right? So remember, the corporate tax rate is 21%, but if you're not a C corporation, you get 20% deduction from your, just to keep things simple, if you make $100,000, 20% of that, easy deduction, $20,000. But if you're an attorney or an accountant or a doctor or any other specified service, trade, or business, and you're making over 400,000 and change, I'm not going to say the exact numbers here, but married and over 400,000 and change with phase outs, you don't get that QBI deduction. And if you are very close, let's say you're like $450,000 and you need some extra deductions, and we've done that for our clients, I would say, well, let's just max out some retirement. Let's prepay some expenses. Let's just bring that income under $390,000, right? I mean, excuse me, on the 450, on the 400, really, it's going to get that, because the phase out is anywhere between 300 and change and 400 and change. But really, that's the goal, to see if we can bring that down, right? So we want to have a reason. Why do we want to prepay, or is it really necessary?
Gotcha.
Does that make sense?
Absolutely. So see, I was wrong on that. I've been told you cannot do leases, and that's what that's why I wanted to ask you, because
when we're talking about lease on the property, yes. As far as the vehicle, I don't think you can, because it's not usually a 12 months, it's more of a 36 month. I haven't seen anything on that. But as far as the property, for example, office rent, you know, especially if you're paying $3,000 a month and you need that $36,000 deduction, you can. Okay. And now here's the thing, I'm going to throw in something here. You might say, well, Boris, I'm not going to do that because I don't want to get my landlord upset. That means he has to pick up a $36,000 income, for example, right? Well, you guys want to learn, you want to know how to do this the legal way? Here it is. You write out a check on December 25, put it in the mail, and the landlord is going to receive it after January 1st. There's no problem with him picking up this income and depositing it in January of next year, picking it up as an income next year, while you get a deduction this year. As long as it leaves your hands, and you wrote down that check, as long as it leaves your hands and it gets to the recipient next year, you're totally fine.
That's good advice. That's good advice. So we're getting near the end of this, and this has been very, very good. Very, very good. I appreciate you doing this. So anything else you want to talk about the Biden administration, or tell us about your new book, or how to contact you?
Yeah, absolutely. So one of the things I do want to mention here to all the listeners, right? The only way to save money on taxes is doing tax planning. And I think Ken is a proof of that, right? He talked about it earlier. Because remember, if you have a tax preparer, you don't have a tax planner, right? At the end of the day, the tax preparer's job is pretty simple, is do the compliance with the IRS, put the right numbers in the right boxes, file the returns, and get it done. Tax planning is something that is, looking, taking a step back and looking at your tax situation, your financial situation, your life, your assets, and really providing you with those strategic tax deductions, right? Tax strategies for you. So that's really my advice, is that everybody who has a profitable business, especially law firm, especially even more so a personal injury law firm, must do tax planning. It's a huge ROI, and it's it will last for years. Those tax strategies are not only used once a year. And we did mention early in the call, I am an author of several books. I think one of the books that will benefit the listeners is Tax Secrets for Attorneys. Everybody who's listening can get this book for free by going to pilmataxcpa.com. Again, that's pilmataxcpa.com. It will redirect you to our website where you can get that book for free. Again, pilmataxcpa.com, and that's really how you can get a hold of us, get your free book, and you will get your free book after scheduling a consultation with me. There will be a link to the calendar on my website. As soon as you schedule, you'll be given that book in a PDF copy, and then you and I, we can speak and see if there's any tax planning and how much can it save you potentially in taxes.
Right. Well, good deal. We'll put that in the notes underneath the podcast page, so that they'll be easy to just click right on it. Okay. Well, listen, thank you so much, Boris. It's as always illuminating, and just keep saving these lawyers' taxes and save me some too. Okay.
Thank you, Ken. I appreciate it very much. Appreciate you having me on your show. Take care.
All right. Take care.
Bye.
Till next time, this is Ken Hardison, dedicated to your success. Goodbye.
You have been listening to the Grow Your Law Firm podcast, the podcast that leads lawyers to more growth, profit, and freedom. Go to growyourlawfirm.com to find more ways to market and manage your law firm. Please leave us a rating and review wherever you listen to your podcasts.